Wayne Scully here, CPA and tax resolution specialist. If you own a business in New York State, this video is a must watch because today I'm breaking down one of the most aggressive collection tactics New York State uses. I'm currently working with a client, Vanessa, who owes nearly $1 million in personally assessed sales tax debt for her now 3 defunct restaurant businesses. And here's the real shocker. New York has issued multiple tax warrants against her, and they've suspended her driver's license. But that's not all. These warrants have destroyed her credit, prevented her from refinancing or selling her home, and have left her in financial ruin. In this video, I'll explain how New York State tax warrants work and how they impact your credit, property, and business, steps to remove a tax warrant or prevent one from being issued, how we're handling Vanessa's case step by step, the key differences between New York State tax warrants and IRS tax liens. If you or someone you know is dealing with a tax warrant, stay tuned. This could save thousands of dollars and a lot of stress. What is a New York State tax warrant? A New York State tax warrant is essentially a legal claim against you for unpaid taxes. Think of it as a judgment in favor of the state. Once issued, New York can seize your bank accounts, garnish your wages, take your real estate and personal property, suspend your business and professional licenses, including your driver's license. Block you from selling property, wreck your credit, making loans and leases harder to get. One of the biggest hidden dangers of a tax warrant is how it completely destroys your financial future. Number one, creditworthiness declines. While New York State tax warrants and IRS tax liens don't appear directly in your credit reports, they're public records that lenders, landlords, and financial institutions can easily access to determine your creditworthiness. This means getting approved for loans, refinancing, or even renting a home can be incredibly difficult. Number two, you can't refinance your mortgage because lenders see it as a major risk. If you try to sell your home, the tax warrant acts as a lien, meaning New York State gets paid before you do. This traps people in financial distress because they can't tap their home's equity or downsize to something more affordable. So let's break down what happened with Vanessa. She co-owned 3 restaurants in New York, but due to financial struggles and a bit of mismanagement, she had to shut them down. She moved on with her life assuming that was it, but she was wrong. Dead wrong. Because the business had unpaid sales tax, New York personally assessed her for those debts. Even though the businesses are long gone, she still is legally responsible for what they owed. Now, with interest and penalties, she owes nearly $1 million. New York issued several tax warrants against her. Her credit has been wrecked, making it impossible to get a loan. She can't refinance her or sell her home because the state has a claim to it. They even suspended her driver's license, making it nearly impossible for her to work and take care of her daily life. But the worst part, Vanessa wasn't even actively running one of these businesses. She was misled into a verbal agreement with her former partner, Derek, the father of her children. When filing an offer in compromise for Vanessa, we're not just submitting numbers. We're telling her full story because tax reviewers are human beings. Vanessa helped Derek start these businesses based on a verbal agreement where she would register the business and he would run operations and handle the taxes. Now the business is closed, but the taxes stayed in her name. Her home is at risk of foreclosure because of the tax lien. She's financially strained as a single mother with no ability to pay. Derek continues to open new businesses under different names as she suspects, while she's left with the debt. This personal statement will be submitted alongside her offer in compromise to give context to her situation and push for the lowest possible. So what are the key differences between a New York State tax warrant and an IRS tax lien? For one, tax liens no longer appear in credit reports, but they're still subject to review by creditors who may want to assess your creditworthiness. They also attach to all current and future assets that you may or will own. They can be removed through various tools, such as an offer in compromise, a payment plan, and so forth. When it comes to New York State tax warrants, though, they're filed with the New York State tax courts and also with the counties. The tax lien acts as a judgment, allowing New York State to seize assets fast. They can lead to license suspension and even business closures. So hey, let's fix their tax problem. Book a consultation with me today by clicking on the link to my Calendly in the description below. Also, you can get a free copy of my tax book, 21 Tax Topics to Stay Compliant and Save Money, available at Amazon.com or www.getmytaxbook.com. Like and subscribe to this video for more tax case breakdowns, and I'll keep you updated on the status of Vanessa's case.